Hello and welcome to Future Generation Investment Insights. My name's Caroline Gurney and I'm the CEO of Future Generation Companies, which are Australia's first listed companies to deliver both investment and social returns. Today, I'm thrilled to be joined by Ben Griffiths. Ben is the co-founder, managing director and portfolio manager of Eley Griffiths Group and a highly respected veteran of the funds management industry. Eley Griffiths is a leading Australian investment management company that specialises in small and emerging companies. And like all our fund managers, they do that on a pro bono basis, which means they don't charge any management or performance fees to our shareholders. This allows us to donate 1% of our assets to not-for-profit organisations that support Australian children and youth at risk. So far, Future Generation Australia has donated more than 32 million, and that is thanks to fund managers like Ben. Ben, thank you so much for being with us today. We're really appreciative.
Great, it's fantastic to be here, Caroline.
So, Ben, you founded Eley Griffiths with your friend and obviously somebody that you respected, Brian Eley, 30 plus years ago, and you've become experts in your area. So the question I really want to kick off with, what is your outlook for the next 6 to 12 months?
Yeah, it's an interesting question, Caroline, and one that I'm getting asked quite a bit, not surprising given the market volatility. Investors need to take note that the Australian share market is sitting nicely on a support line that projects out of the COVID lows back in March 2020. So that is what you want to see as an investor. That's what markets are made of uptrends and downtrends, but uptrends in this case. But unfortunately, the complication that arises is there are a number of cross currents right now that are having a direct bearing on confidence. Citigroup came out with a great note this morning talking about the storm continues, but so does the global growth. And I think that basically underscores the fact that whilst there is volatility, whilst there is some movement in stock prices, there's also a growth impulse that's occurring. Why is that happening? Well, simply central banks have hiked rates and quite aggressively over the last 12 to 15 months. And there is now the great belief that the tightening cycle, the hiking cycle, is near an end. And that is positive, and I think stocks are sensing that that's where we're at. Now, the outlook is a little bit cloudy, hence the storm analogy. I'd look at what's happening in China, where the tailwinds that we're looking for probably aren't coming through. The quality of that recovery is not quite clear. I think central banks have done their bit. That's a positive. The fact they've done their bit and they're close to the conclusion of their hiking campaign. And the final thing that investors should be relieved about and comforted about is the fact that credit markets are somewhat behaved. They are trading at where you would expect normal settings to be. So credit conditions are benign to basically normal rather than being challenging or restrictive, and that's positive for stocks. Investors shouldn't be investing unless credit conditions are broadly supportive, and we have a broadly supportive credit environment. So the outlook is not without challenge, but I think the outlook's positive for stocks.
Obviously, in terms of your business, you've specialised in small caps, and you have a really good understanding of that area of the market. So, obviously, we all know that small caps haven't done very well compared to many others in the market. What's your view on small caps going forward, and when do you think that swing will happen?
Sure, and that's another very valid question. Look, small companies like their bigger cap brothers are sitting on the same support line that projects out from the COVID lows back in March of 2020. That's a bullish thing to see that. But I think the outlook for small caps, investors should be considering divergent performances from stocks. Not every small cap will perform well. We've seen in recent days the consumer stocks, the consumer-facing names, which are principally the retailers who have direct exposure to discretionary spending from households, they're doing a bit tough. And I would expect the environment for that group of stocks to be challenged. On the flip side, I think there's been enormous interest in resources names, and select resource names, I think interest will remain elevated. And when I'm talking resource stocks, I'm talking about the likes of the battery minerals names, the uranium names, and even the gold miners. The Australian dollar gold price is plus or minus $3,000 an ounce. That's pretty close to in fact it is an all-time high for $1 gold. That's very positive for the Australian gold miners. So I think they'll perform well. I think the market is about to swing into a defensive mode given the storm conditions I just mentioned a minute ago. So stocks that have defensive attributes, that is attributes where they'll be able to defend against the cycle, I think will start to perform well. and Ridley's a name that I'd quote there, which is the stock feed producer. That's a well-managed industrial business with very defensive attributes. And the other area that we think, the other sector or subsector of the small cap universe would be those structural growth names, companies that have very, very strong business models, who are either very diversified or exposed to growth areas, or they're getting growth when growth is going to be hard to come by. Names like Tourism Assets and Lavisa are two names that immediately spring to mind.
Oh, that's good, because our shareholders love stock tips. So, but before we go any further, because I'm really interested in some of the areas you're talking about. We've got reporting season coming up in August. Yes. Are you seeing those same themes, and how do you think earnings are going to hold up?
Well, I think those themes that I just mentioned will be, I guess, magnified, and there'll be a great deal of focus on those precise buckets. The confession season, which tends to precede the reporting season, is where we are now, and we've had a number of retail companies come out and advise that trading has become difficult, that people aren't turning up to stores, shoppers aren't fronting, even sales, in the case of baby bunting, sales aren't performing like they used to perform. So I think that environment with the consumer will be difficult and continue to be tough, and I think the confession season has highlighted that retailers will be doing it tough. Normally when the confession season is busy and disruptive and volatile, as we've had, that tends to plant the seed for a difficult reporting season, where the mood of investors is bad or negative. The responses to the market tend to be heavy-handed. So I would think that the confession season tells me there's going to be some volatility coming up. I'd also expect that greater attention than normal will be paid to company CEOs with their outlook statements and how they're foreseeing the next 6 to 12 months, any developing trends, trends in pricing, trends in margin degradation. In the case of contractors, are clients paying their bills more slowly? Are banks getting a bit tough on lending and making it hard to fund? If you're involved in the home building industry, I mean, how are your customers performing? How are the banks going with funding? So all those sorts of signals, I think, will be particularly closely scrutinised during this season. It will be volatile, I think, if the recent weeks' trading performances are anything to go by. But we've been there before. We know that you get good reporting seasons and you get challenging ones, and I just think this one's going to be a little bit tough to ride.
So can I just ask you, I mean, we've said you've had 30 years of experience. Have you seen this before and seen us sort of come through?
I've seen these conditions many times before. I have the welts on my back to prove it. But one thing you know is good businesses with good management teams have invariably managed their cost bases down ahead of or on the cusp of a revenue decline, so that margins are preserved. You'll see some pretty sensible decisions from sensible management teams. And I think a lot of them have been fortifying their businesses anyway, preparing for the regime of higher rates and higher interest expenses and so on. So I think we've already seen some good behaviours. We're going to learn who's actually been preparing for tough conditions. This is part and parcel of equity investing. It's especially germane at the small end, where companies are, they are less ably resourced in many cases versus their bigger counterparts. There's a bit more work to be done at the smaller end, and they tend to be, in the main, exposed to more cyclical type businesses, where you are going to get tossed around by the economy. But it's all part of it's what I signed up for, Caroline.
So I'm also really interested in your thoughts on inflation. I mean, that's what we're all talking about. It feels in a way that we haven't managed to get it under control as everybody thought we would. So what's your view on inflation? How long is it going to take to get under control? And are we going to be at that 2% mark?
Yeah, well, it's been a long time between drinks for the market to have to grapple with inflation. We've had a very sudden surge over the last 12 months or so, or maybe even a bit longer, 15 months. And inflation tends to be a glacial thing. It's hard to eradicate. It takes a long time. I think central banks around the world have used perhaps the bluntest instrument of all, and that's the cost of money. That's interest rate settings. They've done that. But there's a transmission mechanism from tightening rates to seeing the multiplier effects in the economy. It's up to 12 months. So we need to be a bit patient to see whether, in fact, the rapid fire hikes in interest rates have actually achieved what they set out to do. It does feel, if you look at some of the international, the US stats, that the inflation numbers we're seeing have probably peaked. Maybe we have a bit more structural inflation in the system going forward. Various central banks have got targets and objectives where they want to get inflation to. Whether they succeed remains to be seen. But I think we haven't beaten it into submission. But I think central banks of the world are kind of on top of it. Now, a little bit of inflation is also a good thing because that enables pricing power. Corporates can put price increases through, and that's the beginning of margin improvement. So a little bit of inflation is a good thing. There will be exacerbating features like we've just seen with the minimum wage increase and the potential knock-on effects that higher salaries will put through on cost structures and so on. But inflation is, that's the phenomena we're dealing with at the moment. That's the phenomena that central banks, I think, have reacted to appropriately. And we just need a bit of time to see whether we are in fact done and that the tightening works of the central banks globally is near an end. I think equities, as I mentioned in my first point, equities sense that the tightening regime is just about done, and that's why stocks are rallying.
So obviously you're a small cap specialist, and Future Generation Australia is predominantly small caps. Is there anything else we should be telling our shareholders that we haven't discussed now?
Oh, look, I think in trying markets and difficult markets, volatile markets, very easy for investors to lose their nerve and to panic. Investing is a long-term game. And investors need to remember that. Investors need to look at opportunities when the market's under pressure, when good businesses get oversold, when good stocks fall out of favour. They should be thinking about the long run and look to buy those businesses that are well managed, that have got robust business models, that have got sustainable earning streams, that are conservatively funded. I think it's really investors need to focus through the long-term lens. And the market will always be here. The market will have good times and bad. It's the yin and yang of stocks. That's how the markets work. And investors must not lose sight of that. So stay the course would be my suggestion.
Thank you so much, Ben. I mean, I can see now why you are one of our fund managers in Future Generation Australia. So finally, why is being a pro bono fund manager with FGX so important to you?
Yeah, well, it's important because I'm one of the founding managers.
You are.
Jeff Wilson came and knocked on the door and asked for support, and we were there for him. I think it's important, being involved in Future Gen is important for a couple of reasons, but none more important than knowing that what we're doing is actually making a difference. That there was only a handful of charities when Jeff first set sail. I think there's now 10 in the stable, and they're all doing the most magnificent work, and it's just so satisfying. It's one thing to get stocks right and get the portfolio on the right side of the benchmark and do the job you're paid to do. It's another thing to know that in a small way you're making a contribution to the ongoing funding and success of some of those charities. I mean, I have a soft spot for the kids diabetes fund, which I know is an important part of Future Gen, and I love the work they do. I see their annual reports each year, and I love the programs that they set course on. So it's just great. It's very satisfying to know that we're making a difference.
Ben, thank you so much, not only for sharing your insights today, but also for being a pro bono fund manager from the very beginning and managing shareholders' money for Future Generation Australia. As you know, Future Generation has a very diversified portfolio because we have different managers with different investment styles. And it's really because of all of your expertise that Future Generation continues to deliver long-term performance for our shareholders. So thank you very much.